Hello again, everybody. For the next session this afternoon, we have Peter Boerhoff, who's the VAT Director at Vertex, speaking. He's in his role, he provides insight and thought leadership regarding the impact of tax regulations, policy enforcement, and emerging technology trends in global tax. Peter has extensive experience in international transactions, business restructuring, tax process optimization, tax automation. Prior to joining Vertex, Peter was responsible for leading the indirect tax function at Asgo Noble. He is speaking about the rising need for tax transformation technology today. Over to you, Peter.
Yeah, thanks, John, and thanks for having me, and thanks for the introduction. This also saves me one slide, so that's also always good because then we have more time for discussions. Welcome to this session on the rising need for tax technology. And in this session, I will discuss my perspective of why many VAT managers need tax technology, the impact of change on this need, and also how this need may be perceived in the bigger organizational picture. Now I have to move to this one. We did already the introduction. Let's start with some challenging questions, because as a VAT manager in a multinational, what do you really see of what's going on? Do you have the network, the resources, and the skills in place to see what's really happening within your organization? To what extent is what you see built on trust? And to what extent is this built on a true analysis and understanding of people, processes, systems, and your organization? What do you want to see? Where do you believe and feel your responsibilities should begin and end? Do you really want to do data analysis and extensive random checks? Or do you rather stay the internal tax advisor? Where does your role start and where do IT and finance start? What does your organization allow you to see? Do you have access to ERP data? Is your organization prepared to invest in tooling and third-party support to facilitate your seeing? And not unimportant, what does your CFO expect you to see? Will you be held accountable if your organization faces an unexpected VAT hit, impacting the quarterly figures? If yes, is this properly reflected in your job description, job level, responsibility matrix, and your mandate? And finally, what do the tax authorities expect you to see? Do you know this at all? Is it promptly reacting on questions still enough? Or do they expect you to be proactive? And do you know what they can see? And do they have more tax relevant data than you? And do you know how they use this data? So I feel the true question we should ask ourselves is, do you see or are you blindfolded? All of you are most likely aware that VAT is basically everywhere in the business. Traditionally, VAT has always been managed through the reporting or record-to-report process. And usually, the operational VAT knowledge in the business is with the person or persons preparing the VAT return. But often, for these persons, preparing the VAT return is only a marginal routine task annexed to other financial activities. And based on my experience, this activity too often is only about 5% of their time. So most of them do not have the time and resources, and sometimes also not the knowledge, to follow up on the quality checks and data improvements that a VAT manager would like them to do. And even with a centralized and dedicated VAT reporting function, these persons do not manage the input going into a VAT return, as this data is resulting from the sales and purchase processes. So actually, they can also not be held responsible for the quality of the data flowing into the VAT return. So a logical next step in this diagram is that you go back and that you engage with the persons involved in the sales process and make them more aware of VAT. Zero-rated supplies are after all a key risk. So as a VAT manager, you want to get that right. it is crucial that your order-to-cash colleagues clearly understand when a transaction can be zero-rated and what requirements are. Many of your order entry and customer service colleagues are also curious to understand the why, so often they're open for a training on this topic, as they also face the discussions with the customers when there are errors and issues with invoices. But in an average multinational, there are often simply too many to train. And there are also many in sales that simply don't care that much about VAT, as their finance department always manages this. And their sole responsibility is to generate sales and revenue. So if a customer complains about an invoice containing VAT, it's often quite tempting for a sales manager or customer service colleague to simply adjust the customer master data and change the customer tax classification to non-taxable in order to meet customers' expectations. And I've experienced this is one of the aspects where a tax engine comes in handy for a VAT manager to embed automatic VAT controls in the order-to-cash process, thus eliminating non-compliant sales transactions. So let's assume we've tackled this step and AR is fixed. Let's move on to accounts payable. This is typically a process where the VAT treatment of vendor invoices in the ERP system depends on AP clerks manually assigning tax codes. So this process is very prone to errors and definitely needs additional controls for VAT purposes. But who is going to execute the statistical and random relevant checks? The AP department or third-party service provider is on a tight production target, and your finance department is facing limited resources and states it's actually the responsibility of the AP department to embed the necessary controls in their processes. And finally, in many conversations with order to cash and purchase to pay, they are complaining about bad master data. And they have potentially stopped chasing the required improvements as they either don't know where to go, responsiveness is low, or the errors are happening over and over again. And here, I believe also the dilemma for a VAT manager starts. If you're looking at the end-to-end VAT process that's currently on the screen, from master data, the responsibility of many of the processes is scattered around multiple departments. And the VAT manager, in most cases, is not part of any of those departments, and also quite often is not included in any of the responsibility matrices. So why should you care if you're not responsible? And this is where accountability comes in. Who within your organization is the person a CFO or finance director would turn his or her eye on in case of a multi-million euro VAT hit? It's very likely this will be the VAT manager. In the end, he or she is supposed to own the end-to-end VAT process without having responsibility over any of its sub-processes. And here the blindfolding starts, because how do you know VAT is sufficiently prioritized in each of the departments involved? And VAT relevant data is correctly captured and processed in your organization across the globe. But even if you have the dilemma solved, you still have to cope with change. I want to highlight the impact of change in some more detail and from a few angles. It all starts with business and tax controls. To manage the VAT manager dilemma, you need an indirect tax control framework as part of your company's business control environment. This should provide a reasonable assurance that the amounts presented in the financial statements are accurate. The question, however, is if the business control environment is granular enough to provide sufficient controls for VAT. I would say it's not, as materiality in tax audit differs substantially from materiality in financial audits. And does the framework and setup acknowledge that VAT as a transactional tax should not result in substantial financial positions in the profit and loss statement at all? And most traditional control frameworks have been developed a while ago and rely on local resources and processes. So the local finance staff preparing the VAT returns sits at the same location as the local IT manager, the sourcing manager, accounts payable, and customer service. Complex transactions and new ERP settings are discussed locally. The result was that locally the business was in control, but from a global perspective there were little insights, and the system embedded a risk for surprises from a central perspective. Local management was responsible for local operations. They could also manage these operations and actually be responsible, as they also manage the local resources. And now fast forward a couple of years. Does your control framework still rely on local resources? Or has your company's business control framework and your tax control framework evolved along the lines of the changes in business operations? A fact of life for many multinationals is that operations have globalized, all facilitated, of course, by rapid IT developments. Business decisions like centralization, outsourcing, offshoring, etc., have resulted in many functions and processes having shifted globally. As a result, the traditional business control environment and tax control framework can no longer fully rely on local resources. This has also resulted in a push of responsibilities to the various centers. A local manager can no longer absorb the responsibility of ERP settings, updates, finance operations, etc., if these activities are executed and managed abroad. This also causes a shift of VAT responsibilities, either to the tax team or to the regional FinOps teams. And VAT managers need to connect the dots globally. However, at the same time, there's also an increasing need for speed. Frequent changes in VAT legislation, for example because of COVID, need to be captured, tested, and implemented into a company's ERP rapidly. With a centralized tax function that captures and communicates the new rules, IT being done in India, and user acceptance testing being done by FinOps in Poland, how quickly can you really comply with the new VAT rules? And then there's increased digital auditing by tax administrations, which implies that a central tax function needs to have rapid access to transactional data, contracts, etc. Is all of this information really readily available at the central level? And if your VAT team in Poland prepares VAT returns, is there still enough time to align with the accounts payable team in India to have some of the major accounts payable invoices corrected? And how will real-time reporting affect all of this? We all know that there's a lot that can go wrong in each VAT reporting entity. Every VAT manager and every VAT accountant is able to draft a list of top-of-mind VAT issues that should be addressed. In this change control environment, have VAT controls and some common teams improved? With accountability moving to the center of an organization, how do you know, for example, a new customer in Indonesia is classified correctly? How do you know the invoice from a customs agent in Poland containing import VAT and a service fee directed to your Dutch principal was correctly processed by accounts payable in India? How do you know a drop shipment is processed both for accounts payable and accounts receivable under the same VAT number? And how do you know foreign VAT registrations are recorded under the correct SAP partner function? And finally, how do you know that errors discovered in the VAT reporting process get a proper follow-up? Most of all, VAT has become data and process-driven tax. Difficult to properly embed as it's scattered across people, processes, and systems, and differs per organization and entity. And to make it worse, we're working in a very volatile world where change is the norm. Let's first have a quick look at internal changes within your organization. I've listed them, and all of these changes impact either people, processes, systems, or how you are organized. And as a result, these changes are often also influencing the end-to-end VAT process. And each change potentially requires a reconfiguration of your VAT setup and governance. And then there are changes in your systems landscape. IT changes are in most cases initiated internally, but updates and new releases are often forced upon an organization by the software vendor. So this is not initiated internally, but tends to become an external trigger. So I would say this is almost an externally triggered change. In many of these financial systems, VAT settings need to be managed, and this goes beyond only the core ERP system. Many of these systems have not been built for the complexities of global VAT and require substantial customization. And who takes care of this globally in a volatile business environment? And last but not least, we have to deal with a volatile regulatory environment, and tax authorities are moving closer to a business's core processes and require transactional data in real time or nearly real time. So this is difficult to manage with scattered manual processes. So most of you will already be looking at automation to solve this. Besides reporting, we also see VAT technical changes, like for example, the upcoming EU VAT rules for e-commerce and also Brexit, which for many businesses are quite impactful changes. I want to look a little bit closer at digital compliance and how this trend or reporting could develop in the near future. Because as a result of COVID measures, government expenditures have gone up and revenues are forecasted or have already stayed flat or maybe even decreased. So you will see deficits explode. And it's quite clear that governments need funding. So what are some of their options? The digital service tax finds wide international support, besides for the US. So I think it should be expected that countries press ahead from a fair taxation point of view, and that this will be introduced on a global scale. If you look at taxation on labor and also taxation on corporations, it's politically and economically challenging to increase those taxes because taxation on labor impacts current unemployment rates, and taxation on corporations is also not that desired because they're under economic stress and are the drivers for the economy. So environmental taxes and VAT are more likely, with VAT being the more significant source of revenue. An increase in VAT rates is, however, economically less desired, as this impacts overall consumption. And broadening the tax base by eliminating, for example, exemptions, so far has already proven politically challenging in many discussions. But on the other hand, fighting fraud and decreasing the VAT gap and increasing compliance level are likely to receive little objections, especially in the political arena. So this would pave the way for a wider acceptance of e-compliance. Some EU countries have already implemented or announced an invoice clearance model, and recently also Germany joined the pack, as there was a political call to implement an invoice clearance model comparable to Italy. And also globally, this seems to be the trend. If we look a little bit ahead of what's happening in the world, and countries have made announcements, we see a wider spread in, for example, APAC. For example, also in Central Europe with countries like Kazakhstan. You see the trend on the map where the globe gradually turns more yellow, and that reflects the growth of e-invoicing. And the trend is also definitely leaning towards invoice clearance and not towards SAFT or real-time reporting. And you also can see that in the map because the green countries are increasing while the green and the blue countries stay relatively flat. And countries like, for example, Poland use a SAFT introduction as a step up to e-compliance models. And if we return to the simplified end-to-end VAT process, starting with master data and ending with reporting, we will see that the VAT process is impacted at different levels. SAFT reporting, I believe, puts the least stress on an organization. There's a transition phase in which you will need to ensure you're able to collect the right data and put it in the right format. But often this is also supported by ERP and VAT compliance service providers. In the process, there is sufficient time to reconcile the SAFT report with the other VAT reports. And if we look at real-time reporting, the challenge already becomes bigger. The data has to be collected immediate and from different sources. And as a result of timing differences and, for example, invoice processing issues, it's getting more difficult to reconcile VAT data with real-time reported data. Also often, this process is not supported by ERP and traditional VAT compliance providers. So you will have to select and implement alternative solutions. With invoice token or invoice clearance, the impact on the process is significant, as these solutions need to be integrated in a company's core invoice processes. It becomes a license to operate commercially instead of only an additional tax report that needs to be created. And one of the core challenges is that so far, all of these new reporting requirements only put additional admin burden on business and does not make any of the processes easier or more efficient. Some tax administrations now come with the concept of pre-filled VAT returns, which I believe puts even more stress on an organization, because instead of filing a report and the tax authorities investigating possible gaps and errors, with a pre-filled VAT return, businesses will have to check for gaps and errors with their own recorded numbers and their own other reports. So the increasingly popular real-time reporting requires a real-time control framework, or not. Like I already mentioned, VAT is everywhere in the business. The consequence of this is that VAT processes and results are also impacted by changes in many areas, while at the same time, correct and automated VAT processes can facilitate business change instead of being a blocker. But VAT is only a small part of the overall spectrum, but not unimportant, as it's always about being compliant with local VAT rules. And these rules are a given, and operational changes are a choice. As a VAT manager, you most likely see that within your organization there is room for improvement of either the overall level of compliance or for the efficiency in the indirect tax processes. Reduction of transactional error rates, mitigations of risks, and being able to capture opportunities is on the agenda of many. And also the mega trend of digitization of tax authorities is hard to miss. But the move from these VAT manager insights to the implementation of tax technology is a big step. Your insights and perspectives are not by definition shared by the relevant stakeholders within your organization. So how do you justify the additional costs your company has to spend on tax technology, while your current cost of processing VAT and being compliant is perceived to be marginal and is a hidden cost? And especially if your audit exposure in the past few years has never been significant, it's a hard sell. For this, it's crucial to understand the bigger picture, and it would be good to build a stakeholder picture for your tax technology project and assess their personality types in your business. While doing this, you should identify who are decision makers and who are influencers, and also determine who might be consulted by your direct stakeholders in this process. And while listing all relevant stakeholders, make sure you understand or investigate what makes them tick. What is their strategic agenda? What are their operational challenges? And what is their risk appetite? On the strategic level, let's, for example, assume the CFO wants to reduce the overall cost of finance by reducing FTE and centralize finance operations into a few regional shared service centers. In that case, this implies a loss of local tax knowledge, while compliance requirements remain equal or even increase. Implementing a tax engine could facilitate your CFO's ambition. At the operational level, your CIO may face challenges to keep the ERP systems and other systems up to date with constantly changing VAT rules. And finally, risk appetite. What is for your CFO an acceptable level of pain that can come out of a tax audit? What outcome will impact the company's profit and loss and share price? Only a small percentage of a company's transactions have to be processed incorrectly to result in significant VAT corrections. The overall VAT throughput can easily amount to 30 to 40% of revenue. But as these are potential corrections, what is their likelihood? Every stakeholder also has a different angle to look at the challenges and opportunities. And the high-level benefits of VAT automation are to keep your organization out of trouble, to make your organization better and more efficient, or to make your organization future-proof. On all of these three levels, there are many arguments in favor of VAT automation. But also think of the counter-arguments. A bad tax audit for one entity does not automatically imply this is the case for all entities, as they have different people, systems, and processes. An internally identified issue in your VAT numbers does not automatically result in a tax auditor VAT correction with penalties. A potential 5 million impact with a 0% likelihood will receive little attention within your organization. A 25% overall FTE reduction as a result of more efficient tax processes does not result in a tangible benefit if for each of the 150 employees involved, their tax activities are only 5% of the overall activities. And the future by definition is uncertain. So how likely is, for example, the rollout of a definitive VAT system in the EU? Or how likely is the real deployment of an invoice clearance model in Germany? The purpose of identifying all relevant stakeholders and understand what makes them tick is that you want and need them to support your case. Most of the potential savings and efficiencies of tax technology in general are not in the budget of a VAT manager. So a simple statement, we need a tax engine, for many will be Chinese for your audience, as they do not have the specific VAT insights and knowledge a VAT manager has. So if you approach this from a VAT perspective only, you will most likely end up with nothing. In silos, IT, tax, and finance all have their own perception, vision, and priorities with respect to compliance. Tax is accountable and has to get this together. Tax provides direction and IT supports, but in the end, it's the CFO that has to move. The CFO has to approve the investment in tax technology and sign off the investment. But as both tax and IT benefit from tax technology, it's worthwhile for tax and IT to work together in preparing a business case for the CFO. By implementing the right tax technology that covers the end-to-end VAT process, the VAT manager can gain back control, assume accountability over the process, and will no longer be blindfolded. You can centrally manage your VAT settings across multiple platforms and ERPs in a standard way, with content globally managed by VAT experts. At the same time, this also relieves the IT department for keeping systems up to date with frequently changing global VAT rules. The FinOps department will likely experience less stress during tax audits and experience less issues when filing VAT returns. And finally, customer service and procurement will experience less discussions with customers and vendors about invoice issues. Should we consider all of this reality, or is this utopia? Thank you. So I would say let's go to any questions and discussions, Jim and Robert.
Thank you, Peter. I don't see any questions at the moment. Let's just, are there any questions for Peter?
I have to compliment your sense of timing, because you literally ended exactly on the 30 minutes mark.
Endless training, Robert. I repeated all weekend.
Any questions?
Also, comments are welcome. You can raise your hand if you want to come on stage.
We have a question from Reese here. Excellent presentation, Peter. Have you had experience of a head office pushing for technology but subsidiaries resisting the change? Good question.
That's definitely a good question. Because if you push centrally for change and for tax technology, you touch the local kingdoms. And as soon as you take away controls from a local subsidiary, there are people that are not happy with that change. At the same time, however, I must say there are also a lot of local subsidiaries and finance managers often that are happy with a move to the center because they don't feel comfortable with VAT, because they know that their team lacks the experience and the change. So many are also happy. So it can go both ways. But you will definitely find resistance, but you will also find support.
Okay, we have another question here. What is the most difficult part from your experience with Chinese companies?
Chinese companies, whoa, that's a challenging one. There are a few. The first is that of course China has their own tax system, so you really need to dive into the issues and the challenges with the local business. And another challenge that I've experienced with China, it's not specifically with business, but with China, and it's also for more APEC countries. It's more difficult also to build your business case for tax automation there, because labor is not that expensive in those countries. We tend to look at it from a European perspective and think, well, okay, automation is always the most efficient way. But in some countries, it's just easier to recruit some additional hands and hats and put them into the process.
Okay, thank you for that. Any other questions? We've had a comment. This is the best presentation today.
That's good to hear. happy with that comment.
Thank you, Magdalena, for that.
Two more questions coming in.
In your experience, what are the strongest arguments when raising awareness on digitalization?
What are the strongest arguments? Yeah, you need to build awareness, because if you don't have, let's say, VAT awareness within the organization, it's very difficult to convince, or even I would even say it's impossible to convince people of the need. I always say, if you want to make a tax technology investment as a VAT manager by yourself, yeah, it's very difficult to build a business case. So you need to find allies, either in finance or in IT, and preferably in both, and maybe also procurement, to build a business case together. And in order to be able to build that business case, you also need to have this mutual understanding and awareness of each other's issues. So it's not only that you convince others in the organization as a VAT manager that, of course, they need to understand that you need a tax engine, but it's also that you understand, well, okay, but what are their issues? What is their problem? And what is their agenda? And how can I solve their issues? So you do not, let's say, put a VAT problem on their desk, but preferably you solve some of their real life finance or IT issues.
Okay, great. Do you feel the role of the tax professional is becoming more of a data and systems management role, I guess, than tax technical work?
Yeah, definitely. If I look at the old days when I started, and I was meeting with peers, or I went into a meeting where it was a little bit more complex. In many cases, you would take your tax legislation with you, or a smaller book if you had to travel, where you could find the rules. And nowadays, if you have discussions or meetings with peers and VAT managers in the field, and also with customers, everybody's talking about processes, systems, and controls. And every now and then you discuss about, let's say, the newest decision of the European Court of Justice, but it's all about processes, controls, and systems. So definitely a change.
Okay, got a few more here. How can you convince US companies who are operating in EMEA and APAC that they should invest in tax transformation technology? Especially in Europe, tax authorities are planning to go to real-time reporting.
Yeah, to be honest, for US companies, it's quite common to have tax automation in their own region, because in the US, it's for the larger businesses, they all have some form of tax automation, so they quite easily grasp the need for automation, but you have to explain the complexities, because the complexities that we have here in Europe are different than the complexities in the US. In the US, it's all about frequently changing rates at multiple levels in states, counties, while in Europe, it's more about, let's say, the complexities of supply chain. But as soon as you have explained that, and that it's difficult to control those through manual processes, and it's difficult to do that in a timely manner with real-time reporting, to be honest, my feeling is it's easier to convince a US company than a European company, because European companies have always worked in this environment, and many are still set, let's say, take the position, well, okay, we can manage it all in native ERP. We've always done that, so we can always continue doing that.
Okay, there was some follow-ups on the previous question about the role of the tax professional. Yeah, tax advisors are becoming tax engineers. Reese says, agree on the role of the professionals, but automation must rely on the judgment skills of an expert. It's about finding the balance between otherwise garbage in, garbage out.
Yeah, a valid comment.
Yeah. Okay, what are your thoughts on how to best raise awareness within the business with regards to the importance of tax-sensitive data?
That's a recurring this discussion actually. What I've done once when I was still managing within a company, I was also pushing for. We were in a restructuring. I was also pushing for tax technology, and then the IT department was a bit resistant. They said, well, okay, we can manage this in ERP. We've always done it. We don't have any issues. So what I did is I said, well, okay, have a look at your system. Have a look at a number of scenarios. I discussed a number of scenarios with them. I said, well, okay, investigate how these scenarios are processed and what the VAT outcome is. And after, I think it was a week, maybe two, this IT manager came back to me and he said, well, I did this investigation. I looked into the system. I looked in how it was structured and set up. And that didn't make him very happy. And he also concluded that the number of transactions as it was programmed into the system was not compliant. So yeah, that created an ally for me. He was absolutely convinced that we needed to go for technology.
Okay, thank you. We have a very specific Brazil question for you.
Ooh, that's probably a difficult one. Don't know if I can tackle that.
Well, let's ask you anyway, then you can decide whether you have the knowledge already. Have you made any changes at Vertex to reflect the recent judgment on in the Constitutional Court in Brazil around the transport of own goods being out of scope, as there is much uncertainty surrounding it? How do you tackle this as a third-party provider?
You see me smiling, I don't know the answer. So if you can send it over, including who raised the question, then I really need to reach out to our Brazilian team and the technical guys to see how we resolved it. I don't know that.
Yep,
okay.
We'll do so. I think we're out of time.
Okay. Well, thank you very much, Peter. I think everybody said this is one of the best presentations today so far. So thank you for your time. Appreciate it.
Thank you very much, and looking forward for the rest of the sessions.
Yeah, we have some great afternoon sessions, some very concrete corporate case study type presentations. And so we can take a quick break and we'll come back with the GSK session. So thank you everyone for your attention, and we'll be back in a moment.